The balance sheet shows what a company owns and owes, but unusual patterns can reveal risks. Here are the red flags to watch. Alright, let's talk about the balance sheet. I know the words balance sheet can feel like a one-way ticket to Snoozeville. But stick with me here, because this document is actually a fascinating, high-stakes story about a company's life. At its core, a balance sheet is just a snapshot, a selfie of a company on a single day, like December 31st. It tells you two main things: what the company owns, assets, and what it owes, liabilities. The difference? Owner's stake. Equity. Simple equation: assets equal liabilities plus equity. It has to balance. It's the law of accounting. Our first red flag is a classic: receivables growing faster than sales. Okay, what are receivables? They're the money that customers owe the company. It's an IOU from your customers. So, let's say a company, Wobbly Widgets Incorporated, sells $1 million worth of widgets. That's $1 million in sales, which is great. But if their receivables also jumped by $1 million, it means they haven't actually collected any cash yet. Now, it's normal for receivables to grow as sales grow. But if sales increase by 10% and receivables shoot up by 40%, that's a red flag. Now let's turn our attention to the warehouse for our second red flag: inventories rising faster than sales. Inventory is all the stuff a company has on its shelves waiting to be sold. If sales are up 5%, but the pile of unsold widgets in the warehouse is up 30%, something is off. This is also measured by something called inventory turnover, which tells you how quickly a company sells its stuff. If that turnover rate is slowing down, it's the same red flag in a different costume. Let's combine our last two red flags to create a new, even bigger one: receivables plus inventories, making up a big share of total assets. While these are technically assets, they are not as good as cold, hard cash, or a productive factory. They are what we call soft assets. Their actual value can be uncertain. Will those customers ever pay? Will those widgets ever sell? When a huge chunk of a company's worth is tied up in these two question marks, it's a sign of potential instability. This is a red flag because the company's foundation might be squishy. A business built primarily on IOUs and unsold goods is vulnerable. You want to see a healthy mix of assets: cash, property, equipment, and yes, some receivables and some inventory. But when those last two dominate the picture, the company's balance sheet is less of a fortress and more of a house of cards. Now for a counterintuitive one. Red flag number 4: unusually large cash balances compared to operating activity. Wait, how can having too much cash be a bad thing? Isn't cash king? Well, yes, but a king who just sits on his throne and never does anything isn't a very effective ruler. Companies are supposed to use their cash to generate more value, investing in new projects, developing new products, expanding into new markets. A massive pile of cash just sitting in a bank account, earning very little interest, can be a sign of a company that has run out of good ideas. It's a sign of stagnation disguised as safety. Let's venture into the spookier side of the balance sheet with red flag number 5: a sudden increase in goodwill or other intangible assets. So what on earth is goodwill? When one company buys another, it often pays more than the book value of the assets it's acquiring. That extra amount it pays is recorded on the balance sheet as an asset called goodwill. It represents things like brand reputation, customer relationships, other non-physical stuff. Now this isn't inherently bad, but a sudden massive spike in goodwill, especially if it's not from a well-publicized, sensible acquisition, is a huge red flag. It can be a place where financial shenanigans are hidden. Companies that are desperate to make their balance sheets look stronger might go on a buying spree, acquiring other companies at inflated prices. The problem is that goodwill is not a real physical thing you can sell to pay the bills. Moving from ghost assets to a very real monster, we have red flag number 6: rapidly rising debt compared to equity or assets. This is measured by the debt-to-equity ratio and debt-to-asset ratio. A little bit of debt can be a good thing for a company. It's called leverage, and it can amplify returns. Think of it like using a loan to buy a house. You can control a large asset with a small amount of your own money. But just like with a personal mortgage, too much debt can be crushing. If you see a company's debt levels skyrocketing while its equity or assets are staying flat, or growing much more slowly, the alarm bell should be ringing loud and clear. This is a classic sign of a company in distress. It might be borrowing money not for exciting new growth projects, but simply to cover its day-to-day operating costs, a process known as borrowing to stay alive. Diving deeper into the debt monster, we find our seventh red flag, a spike in short-term debt. Debt comes in two main flavors: long-term, like a 30-year mortgage on a factory, and short-term, which is typically due within 1 year. But a sudden dramatic increase in the amount of short-term debt is worrying. It often means that lenders are getting nervous about the company's long-term prospects. They are no longer willing to lend money for 5 or 10 years. They want their money back, and they want it back soon. This shift from long-term to short-term financing puts the company in a precarious position. It's called rollover risk. The company is constantly having to find new loans to pay off the old ones that are coming due. This is a high-wire act without a safety net. If, for any reason, the credit markets tighten or lenders decide the company is too risky, the money tap gets turned off. When that happens, the company can face a sudden liquidity crisis. Next, we have a truly sneaky one. Red flag number 8, a falling current ratio despite reported profits. First, the current ratio is a simple health check. You take your current assets, cash, receivables, inventory, and divide them by your current liabilities, which are bills due within a year. A ratio above 1.5 or 2 is generally seen as healthy. It means you have plenty of short-term resources to cover your short-term bills. Now, you would expect that if a company is reporting strong profits, its financial health would be improving and its current ratio would be stable or rising. But what if the opposite is happening? This is a major disconnect that suggests the reported profits might be an illusion. How can this happen? Well, remember our discussion about aggressive sales tactics. A company might be booking huge sales on credit to customers who won't pay for a long time, or ever. This boosts profit on the income statement, but it doesn't bring in cash. Meanwhile, the company still has to pay its own bills, to its suppliers, its employees, its landlord. So, current liabilities are going up, but the useful current assets, cash, aren't. The result is a falling current ratio, revealing that the company's actual ability to pay its bills is getting weaker, even as it boasts about its profitability. It's a profit mirage in a liquidity desert. We're getting close to solving our financial mystery. Let's examine the final trio of red flags that can reveal the deepest secrets hidden in a company's balance sheet. Our ninth red flag is another one that plays on the disconnect between paper profits and reality: rising net worth or retained earnings while cash and assets stagnate. Retained earnings are the profits a company has accumulated over time and hasn't paid out as dividends. So, if a company is consistently profitable, its retained earnings, net worth, equity, should be growing. But if you see this number going up and up on the balance sheet, yet the company's cash balance, factories, equipment are flat, you need to be skeptical. Where did all that supposed profit go? This situation often points back to the same issues we've already discussed: phantom profits. The company could be aggressively recognizing revenue, but that revenue is getting stuck in receivables that aren't being collected. It's like telling everyone you got a huge raise, but your bank account balance never changes because all the extra money is going to pay off high-interest loans. The equity on the balance sheet looks great, but the company's actual financial substance isn't growing at all. It's a hollow victory. Next up, the 10th red flag, and it's a sign of pure obfuscation: large, unexplained other assets or other liabilities categories. The balance sheet is supposed to be a tool for clarity. You want to see specific line items: cash, inventory, accounts payable, long-term debt. But sometimes you'll find a giant mysterious bucket labeled other assets, other current liabilities, with no explanation in the footnotes. This is the financial equivalent of sweeping a huge mess under the rug. When a company lumps a significant portion of its assets or liabilities into a vague other category, it's often because they don't want you to know what's in there. It's a deliberate lack of transparency, and you should always assume the worst. Finally, we have red flag number 11, consistently negative working capital in an industry where it should be positive. Working capital is current assets minus current liabilities. For most businesses like manufacturing, retail, you need this to be positive. You need more short-term resources than short-term obligations to have a buffer. But some industries like grocery stores, subscription businesses, Netflix, can operate with negative working capital. They get cash from customers immediately, but pay their suppliers later. The key here is context. If Wobbly Widgets, a manufacturer, has negative working capital year after year, it's a sign of chronic distress. It means they are constantly scrambling to pay their bills and have no buffer for emergencies. It's a sign of a company living perilously close to the edge. And so, by spotting these red flags, we move from being passive readers of a boring report to active detectives, uncovering the real story of a company's financial health. Let's quickly recap our 11 red flags. Receivables growing faster than sales, inventories rising faster than sales, receivables and inventories dominating assets, unusually large cash balances, sudden increases in goodwill, rapidly rising debt, spikes in short-term debt, falling current ratios despite profits, rising retained earnings with stagnant assets, large unexplained categories, and negative working capital in inappropriate industries. These balance sheet red flags may reveal hidden liquidity or solvency risks. Each one tells a story about potential problems lurking beneath the surface of seemingly healthy financial statements. Armed with this knowledge, you're no longer at the mercy of corporate spin. You can read between the lines and spot the warning signs before they become disasters. Remember, spotting these red flags is a superpower that lets you see through the carefully crafted narratives and get to the financial truth. The balance sheet may have seemed like just a boring list of numbers, but now you know it's actually a thrilling detective story waiting to be solved. Every line item is a clue, every ratio is evidence. So the next time you look at a company's financials, don't just glance at the profit numbers. Dig deeper. Look for these red flags. Ask the tough questions. Your financial future may depend on it. These 11 red flags are your roadmap to financial truth. Use them wisely, and you'll never look at a balance sheet the same way again. Happy investigating!